A pleasant day to all. Last video presentation we discussed about capitalization. We have learned that the company needs to have good management of capital because it can really affect the business operations. Apart from the learning we have gained from lessons on capitalization, we need as well to study different things that make this capitalization up. So, for this video presentation, we will discuss about capital structure. Capital structure refers to the kinds of securities and the proportionate amounts that make up capitalization. It is the mix of different sources of long-term sources such as equity shares, preference shares, debentures, long-term loans, and retained earnings. With this presentation, we will study how the company capital structure finances its operations using the funds being obtained from different sources. Capital structure is sometimes referred to as financial leverage, as each business has to consider the optimal ratio for running its business between debt and equity. Now, why capital structure is important for both company and other stakeholders like banks and other lenders. Always remember that the capital structure of the company can be used as a measurement of its capability to source funds. For example, FM Ventures desires to source fund from JMN Bank, assuming that this bank is one of the well-known banks in the Philippines. Before JMN Bank approves the loan of FM Ventures, it can be considered first the risk in helping the company to finance its operations. If the FM Ventures appears to be highly leveraged with substantially more debt than equity, it is a greater risk, as the company owes more than it earns, while a low-leveraged company appears to be less of a risk, as it earns more than it owes. In other definition of the capital structure, it refers to the amount of debt and or equity employed by a firm to fund its operations and finance its assets. A firm's capital structure is typically expressed as a debt-to-equity or debt-to-capital ratio. Debt and equity capital are used to fund a business's operations, capital expenditures, acquisitions, and other investments. There are trade-offs firms have to make when they decide whether to use debt or equity to finance operations, and managers will balance the two to find the optimal capital structure. In the presented picture, we can see that the company uses its equity more than its debt to finance the business operations, including the purchase of the company's assets. We can see as well that the company's capital structure consists of more equity than debt. It means that the company is low leveraged. Like what we have mentioned a while ago, if the company low leveraged, it seems to be less of a risk because it earns more than it owes. But before we proceed further on the discussion of capital structure, let's also include the financial structure in the discussion, since sometimes, others are being confused between the two concepts. So, to better understand more about the capital structure, let us discuss their main differences. Financial structure shows the pattern total financing. It measures the extent to which total funds are available to finance the total assets of the business. Or we can say it is the mix of debt and equities that a company uses to finance its assets and manage its day-to-day operations. But take note that the debt and equity that make up the financial structure are short-term debt, long-term debt, short-term liabilities, and owner's equity. Moreover, remember that in order for you to identify the financial structure of the company, you can consider this formula. Financial structure is equal to total liabilities, or financial structure equals capital structure plus current liabilities. Take note the financial structure with more debt may give higher return on investment, may be more risky. To better understand the main difference of financial and capital structure, you may consider the comparison table. When we say financial structure, it includes both long-term and short-term sources of funds, while capital structure includes only long-term source of funds. Financial structure means the entire liabilities side if the balance sheet, while capital structure means only the long-term liabilities of the firm. Financial structure consists of all sources of capital, while capital consists of equity, preference, and retained earnings capital. Lastly, financial structure will not be more important while determining the value of the firm, while capital structure is one of the major determinations of the value of the firm. Moving forward, in studying capital structure, we have the concept called optimum capital structure. It is the capital structure at which the weighted average cost of capital is minimum and thereby the value of the firm is maximum. Optimum capital structure may be defined as the capital structure or combination of debt and equity that leads to the maximum value of the firm. For better understanding about optimum capital structure, please take a look at the following illustration. So, in the presented illustration, we have the low leverage and high leverage capital structure. In one hand, the company is low leverage if the value of its equity is higher than its debt. It means that the company uses its outstanding equity more than its debt to finance its assets. On the other hand, the company is high leverage if the value of its debt is higher than the company's equity. It means the company uses its debt more than its equity to finance its assets. So, when the company minimizes the cost of capital and maximizes its value, then the company is using optimal capital structure. Take note that when the company maximizes the leverage of its capital structure, the weighted average of the cost of capital increases, then the value of the firm decreases. When the company optimizes its capital structure, the weighted average of the cost of capital decreases and the value of the firm increases. We will discuss how to calculate the optimal capital structure on the succeeding video presentations. Moving on, capital structure have its main purpose. Financial managers should always remember these objectives when identifying the capital structure of the firm. Decision of capital structure aims at the following two important objectives. Maximize the value of the firm. Minimize the overall cost of capital. The following are different forms of capital structure. Equity shares only. Equity and preference shares only. Equity and debentures only. Equity shares, preference shares, and debentures. Take note that the company should decide what form of capital structure to utilize for them to realize the objectives of the capital structure. Following are the factors that play an important role in determining the capital structure. We have leverage, cost of capital, and government policy. Leverage. It is an investment strategy wherein the company is using the borrowed money, specifically the use of various financial instruments or borrowed capital, to increase the potential return of an investment. Costs of capital. It is the cost that is incurred in raising capital from different fund sources. A firm or a business should generate sufficient revenue so that the cost of capital can be met and growth can be financed. Government policies. The capital structure is also impacted by the rules and policies set by the government. Changes in monetary and fiscal policies result in bringing about changes in capital structure decisions. Let us discuss these factors individually. The first factor is the leverage. It is the basic and important factor, which affect the capital structure. It uses the fixed cost financing such as debt, equity, and preference share capital. It is closely related to the overall cost of capital. The concept of leverage is used by both investors and companies. In the point of view of the investors, leverage is very helpful for them to multiply their purchasing power, while in the viewpoint of financial manager or chief financial officer or any financial decision maker of the company, leverage is relevant to finance the company's assets. Instead of issuing stock to raise capital, companies can use debt to invest in business operations in an attempt to increase shareholder value. In the business world, a company can use leverage to generate shareholder wealth, but if it fails to do so, the interest expense and credit risk of default destroy shareholder value. Basic example of leverage. Rolly Corporation was formed with $5 million investment. This will be the initial capital of the company and the money that can be used for business operations. If the company uses debt financing by borrowing $20 million to Quintana Bank, the company has capital of $25 million for business operations. This is the means of the company to increase their capital and to have an opportunity of increasing the value for their shareholders. Another factor is the cost of capital. It is the minimum rate of return that a business must earn before generating value. Before a business can turn a profit, it must at least generate sufficient income to cover the cost of the capital it uses to fund its operations. This consists of both the cost of debt and the cost of equity used for financing a business. It can be used extensively in the capital budgeting process to determine whether a company should proceed with a project. Another way to describe the cost of capital is the opportunity cost of making an investment in a business. More companies are being practical in investing in the certain business or project. They tend to invest only in an initiatives if there is an assurance of returns that exceed the cost of their capital. In other words, it is an assessment of the risk of a company's equity. Thus, cost of capital is a very important factor to be considered by the company in terms of the firm's capital structure. There are different factors the company should consider because these factors can affect the company's cost of capital. Remember that high cost of capital can have an effect on not only how the investors go about securing funding for the project, but also how much of a return must be generated in order to make the endeavor worth the effort. So, in order for the firm to lessen their cost of capital, they should consider these factors. The company should be knowledgeable about the nature of its business. Use of fixed interest or dividend-bearing finance depends upon the nature of the business. If the business consists of long period of operation, it will apply for equity than debt, and it will reduce the cost of capital. Size of the company also affects the capital structure of a firm. If the firm belongs to large scale, it can manage the financial requirements with the help of internal sources. But if it is small size, they will go for external finance. It consists of high cost of capital. Legal requirements are also one of the considerations while dividing the capital structure of a firm. For example, banking companies are restricted to raise funds from some sources. The last consideration is the requirements of investors. It is necessary on the side of company to consider the requirement of investors. In order for the company to generate funds from the investors, the company should have the appropriate sources of securities to issue for the investors. These securities should be appropriate to the requirements of investors. It will help the company to reduce its cost of capital. Finally, government policy is also one of the factors to consider when we are talking about the capital structure. It restricts to mobilize large, long-term funds from external sources. Government policies are always there to oversee the legalities of the company's decision, most especially in terms of investment decision that may affect the investors' interests. Generally, the company needs to consider the laws and regulations being implemented by the government for the smooth or efficient financial management practices. After the discussion of different factors affecting the capital structures, let's now move on to the discussion of its importance. As what we have mentioned in the earlier part of the discussion, capital structure is very vital for a firm as it determines the overall stability of a company. Here are some of the other factors that highlight the importance of capital structure. 1. A firm having a sound capital structure has a higher chance of increasing the market price of the shares and securities that it possesses. It will lead to a higher valuation in the market. If the firm can able to manage the capital structure effectively, then it will increase the value of the firm in the market. 2. A good capital structure ensures that the available funds are used effectively. Last time we have discussed all about the different types of capitalization, and we also learned that if the firm can't able to manage the available assets, it might reflect to either under or over capitalization. Thus, having a good capital structure prevents over or under capitalization. 3. It helps the company in increasing its profits in the form of higher returns to stakeholders. If the company have a good standing in terms of capital structure, it will increase the capacity of the firm to generate more funds. If the firm get increase its funds or capital, there is also a high potential to gain more profit. 4. A proper capital structure helps in maximizing shareholders' capital while minimizing the overall cost of the capital. The objective of the capital structure is to minimize the cost of capital and maximize the shareholders' value. It means that the company can able to achieve these objectives if there is a good capital structure. Lastly, a good capital structure provides firms with the flexibility of increasing or decreasing the debt capital as per the situation. The company can able to optimize the capital structure. A firm can decide which of the capital will be used to increase its value. Do you have any question? For your clarification and queries, kindly notify me. Please wait for more instructions about the task associated on this topic. Thank you and have a blessed day.